So the next thing we're going to look at today is going to be income tax. We're going to talk about how income tax works, how you are taxed, and things like that. Income tax is really interesting, mostly because this is something that affects all of us. Any of us who work or are going to be working one day, we're paying income tax on that. Even if you get a refund each year when you file your taxes, you still are almost certainly paying income tax and I'll explain why here today. So income tax is just a percentage of your income collected by the government for whatever the government does for taxes. The government does a lot of things with tax money. A lot of its necessary functions, it requires money to do things. They got to pay people. They got to, um, pay for services and supplies, things that they distribute. So the government is very instrumental in doing those kinds of things and definitely requires income tax. Uh, Benjamin Franklin once famously said, "The only two certainties in life are death and taxes." Death and taxes. So take from that what you will. So there's a couple things you need to do in order to calculate your income tax. Um, your gross income, that's kind of the first thing you look at is your gross income. And what that is that's just your total dollar earnings for the year. That's everything. Wages, tips, earnings from investments, that's a big one. If you collect unemployment for all or part of the year, that counts as gross income to you. What you're able to do then is subtract off some adjustments. Now, the tax laws are changing every year. During the Trump administration, a lot of things changed with the tax laws, specifically the standard deduction, as it's called. We'll see what that is here a little bit today. And it mostly did that to wipe out certain types of exemptions, but it actually raised the total you could deduct. So we will see how President Biden's new tax policies are enacted. What you're going to do is you're going to take your gross income, you're going to subtract off certain adjustments. We'll talk about what counts as an adjustment. Here's what you want to do. Your gross income is how much money you really made for the year. You want your gross income to be high, but here's the thing. You're going to be taxed only on a portion of your income. So for instance, if you make $100,000 a year, that's just an easy number to work with. That's certainly a really good salary to make. If you made $100,000 in a year and you had $10,000 in adjustments, well, that now the government is going to subtract $10,000 off the top and only look at $90,000 initially. That's called your adjusted gross income. So you actually want as many adjustments as you can get because the government then will only consider you as having a $90,000 adjusted gross income. On top of that, we're also going to subtract any exemptions, which those work a little differently now. So we're going to have to be careful with those. We're also going to subtract off certain things you get to deduct from your income. So adjustments, exemptions, and deductions are all good things. I'll write that out. All good things. Because the more you have of those things, the more that gets subtracted off of your income. Now, it's not literally being subtracted, meaning it's not like having these things, literally you have to pay for them. It's more like it's just subtracting what the government looks at as your income. So if you make $100,000 a year, you have $10,000 in adjustments, you have $5,000 in exemptions, and then you get $12,000 for deductions. That's going to be $27,000 total that gets subtracted off your income, bringing your taxable income down to $73,000, which means the government doesn't look at the full $100,000 you really made. The government only looks at $73,000, and thus it only taxes you under the $73,000 income. That's good. The less income the government sees, the less you're going to be paying in taxes. And so these all have specific rules. Exemptions don't quite work the way as they do. Right now it says you get a fixed amount for yourself. They did away with that under Trump, under Donald Trump. In the first year was, I think, 2018. And what they did was they increased something called the standard deduction to compensate for that. But you can still take out exemptions for anyone that you are supporting, which is usually children. But if you have a family member that lives with you that you provide more than, I think, 50% of their whatever they need, their needs, housing, food, etc. When it comes to deductions, you can choose an itemized list of deductions. Those are very specific. Things like mortgage interest that you paid on a home, things like that. If you itemize your deductions and you realize there's not a whole lot to it, you can actually take something called the standard deduction, which is a fixed amount of money based on the tax year and based on your status. And so ultimately, the amount of income tax you're going to owe, you compute how much you owe in taxes, but then if for some reason you get certain tax credits, you can cut that off of what you owe. And so, just like adjustments, deductions, and exemptions, tax credits are also good. Tax credits are very good. You want to get as many tax credits as you can. One tax credit to look at seriously for people that are mostly your age, which a lot of you are younger, 18 to 22-year-old students. Some of you might be older students coming back to school, and you may also qualify for this. One tax credit to look at seriously is the Earned Income Credit. Now, it has certain rules. I think you have to be at least a certain age to get it. So this might not be something that you're going to get right away. You may have to wait a few years, but I think you can claim up to 4 years of the Earned Income Credit, and it's a nice little tax benefit. So we will look at all these things. So let's pause for a second. What we're going to do is we're going to look at some tables, some charts. We're going to figure out how much tax this guy is going to owe. It looks bad, but it's really not as bad as you'd think. It's also important that we understand the computation behind all this, because it is greatly going to affect how we pay our taxes and how much we have to pay when we do pay taxes. There's a lot of things that you can do that are all 100% legal to reduce your tax bill. So let's say a single man earned $46,500 just from his wages at his job. Let's say he got $1,850 in interest from a savings account. So the interest was his, he earned it, as opposed to having to pay it. And then he also received $15,000 in winnings on a television game show. He also contributed $2,300 to a tax-deferred savings plan. He's entitled to a personal exemption of $3,800. That's not going to be around anymore, but for this computation, we'll put it in there. He can have the standard deduction of $5,950. The interest on his home mortgage was $6,500. He paid $2,100 in property taxes and $1,855 in state taxes. He also contributed $3,000 to charity. So that's this man's year, whatever year this is. This was some of his economic activity. So first we're going to determine his gross income. And you can see, you may not know how to calculate all these yet. That's kind of what this sample problem is about. The gross income is just going to be take his $46,500, add the $1,850 he earned in interest, and add $15,000 he won on a game show. You're not going to add the $2,300. That's money that he put away into a savings plan. So his gross income was those three things added together. $63,350. So that's basically the total amount of money he brought in for his income for the year. That's not a bad little amount of money. Now the man's adjusted gross income. Now you have to be careful. If we go back up here, we're going to get some good definitions for what counts as an adjustment, what counts as an exemption, and what counts as a deduction. The most popular adjustment you can make is payments to any tax deferred savings plans. What in the world is a tax deferred savings plan? Let's say you're saving for retirement and they say, okay, if you put this much money into retirement each year, that is an amount of money you can subtract off your income. And thus you'll owe less taxes this year because you are saving for retirement. That's the entire reason that adjustments like that exist. So that's a tax deferred savings plan. It has that benefit so that it promotes people saving their money for retirement because then they have to pay less taxes in the year that they saved that money. So you get a little bit of a kind of a bonus from the government for saving for retirement. Now, things like a Roth IRA, especially a Roth IRA, which is a very popular retirement savings vehicle, in a Roth IRA, you do not get to subtract off your income or what you contribute to the year from your income. And the difference, though, is that whenever you're ready to retire and take money out of your Roth IRA, you're not taxed then. You're only taxed when you put the money in. So it's kind of a confusing mess. For the moment, let's just say any payments to a tax deferred savings plan is going to be an adjustment. So we take his gross income that we calculated to be $63,350, and we actually subtract off the $2,300 he put towards a tax-deferred savings plan. So now what we call his adjusted gross income, his AGI, adjusted gross income, that's going to be $61,050. So we're already starting the process of lowering the income that he made for the year that the government's going to look at, which is a good thing. You want the government to think you made less money. You're not fooling the government either. It's just saying this is money that the government will ignore when it comes time to pay your taxes. You're not lying. You're not cheating. Everything we're doing here is legal and is actually the smart thing to do. All right, continuing on, we need to determine his taxable income. We need to take his adjusted gross income. We need to subtract off any exemptions that he gets, any other kinds of exemptions, things like that. Let me look at something real quick. It looks like there was an error made. Okay, so let's say the man actually gets a personal exemption of $4,050. I don't know why this made that mistake. So we're going to subtract exemptions and deductions from the man's adjusted gross income. He gets a personal exemption of $4,050. Now his standard deduction is $6,300. However, man, these numbers are way wrong. Hold on. However, there are certain things he can itemize. He can say, okay, the interest he paid on his home mortgage was $6,500, which is pretty steep. He's in a pretty expensive home, or he has a really high interest rate. He paid $2,100 in property taxes. He paid $1,855 in state taxes, and he contributed $3,000 to charity. So these things here, we'll highlight them. These things here, these are itemized deductions. And here's the thing. You get to decide whether you will go with your itemized deductions or the standard deduction. Now, most of us, when we're young, we're not going to have a lot of these itemized deductions, but you get to pick whichever is higher. And you want to pick whichever is higher because remember, this is a deduction. It's being subtracted off of your income. So then the government will think that you are making less in income. So what we're going to do, we need to add up all these values, the $6,500 for mortgage interest, $2,100 for property tax, $1,855 for state tax, and then the $3,000 he contributed to charity. These are all going to be itemized deductions. If we add all these up and they come out greater than the standard deduction, then we actually want to use itemized deductions. And that's clearly what's going to happen here. If we add all of these up, we're going to end up with $13,455 in itemized deductions. And that's much larger than the standard deduction. So we're going to use itemized deductions here. If, however, we had added these numbers up and they came out to less than the standard deduction, let's say they only came out to $2,000, which is going to be the case for a lot of young people. A lot of young people don't have these itemized deductions unless you're contributing to charity. We don't have a state tax in Texas. And if you don't own a home, a lot of young people aren't going to own their own home. Usually you're renting. You're not going to have interest on your mortgage. You're not going to be paying property taxes. So if your itemized deductions are less than the standard deduction, you'll take the standard deduction because it's larger, and thus you can deduct more. What Donald Trump did, or I say Donald Trump, I really just mean how the tax law changed when he was president. He doubled the standard deductions. He got rid of personal exemptions. So this $4,050 personal exemption doesn't exist anymore. And so generally speaking, people in lower income brackets actually saved money on taxes. But anyways, so the total amount we're going to deduct is $13,455 for deductions. We're also going to subtract off $4,050. So we take the adjusted gross income, which remember we computed to be $61,050. That was his total income for the year minus what he put towards that savings plan. Then we're going to add up the exemptions and deductions. He gets $4,050 in exemptions for himself. He chose to itemize his deductions because it was greater, and that was $13,455. Add them up, you get $17,505. You knock that off from $61,050, his adjusted gross income, and you end up with $43,545, which this is the man's taxable income. It's how much money the government is really going to look at for computing his taxes. You want to get this as low as you legally can. Absolutely, you want to do that. You want to get that as low as you possibly can, because then the government will say you earned less in income. And by doing that, that means your taxes are going to be lower. And of course, you want your taxes to be as low as you can legally get them. Do not try to cheat the government. So a common thing one could do in theory, I had a friend's, I think it was his uncle, who was cheating the government. Because what happens is back then you got to take an exemption of $4,050 for yourself, but you also got to take an additional $4,050 for every person you were supporting in your household, which is usually children. And what this guy would do is he would claim that he had 99 children. And so he got to deduct or, subtract off a ton of money from his income, and he never paid taxes. Well, the government's not stupid. They figured it out. He'd been doing it for years. The government finally caught up with him and said, hey, you're claiming a really high gross income, because they still know what you're grossing. They're saying you still made $100,000 a year, but you've been paying $0 in taxes. And someone realized it's because you're claiming 99 children. Of course, you don't have 99 children. And so what the government did was they computed all the back taxes he should have been paying. So over the years, what he should have paid, they added it all up. They tacked interest onto it, meaning for every year he didn't pay, they charged him interest on that. And then they sent him a bill. The bill was for like $250,000, something ridiculous like that. They gave him a little time to pay it, but he broke the law. And if you actually don't pay that bill, you'll get jail time. Even if you are planning to pay the bill that they send you and you pay it on time, they may still consider giving you jail time depending on how egregiously you tried to cheat the government. So my humble suggestion to all of you, definitely do not try to cheat the government. Do not try to lie on your taxes. I really, truly think they're going to figure you out eventually. And then you're going to owe a ton and you might even go to prison over it. But anyways, the bottom line is the man, in actuality, earned, you'll remember, the man earned $63,350 for the year, but the government is only going to look at $43,545. That's a good thing. That means the government is going to tax you at a lower rate, basically. Now, here's how the tax system works. They're going to take your taxable income. They don't just say, oh, okay, well, $43,545, that is in this bracket here. That's in this bracket right here. You're a single person. Oh, so we're going to take 25% of your taxes, or 25% of your taxable income, and that's what you owe the government. No, that's not how it works. This guy earned $43,545. The first $9,275 is going to be taxed at $10,000, or excuse me, at 10%. The first $9,275 is taxed at 10%. So not all of it's taxed at 25%, just the amount of money that falls here. Then every dollar this man earned between $9,276 and $37,650, that's taxed at a little bit higher rate at 15%. And finally, this man is in the 25% bracket. It just means that he climbed up this high. Finally, every dollar this man earned between $37,651 and the $43,545 that he actually earned, that's going to be taxed at 25%. That's how you read these charts. So look at this. If you file married, but you're filing separately from your partner, you're taxed. It's very similar to, at least early on, it's very similar to the single filing. If you're married, but you're filing jointly and you're adding your two incomes together, you're going to be taxed at this level. And notice all the limits are raised. You get to only pay 10% up to $18,550. And then up here, the limits are much higher than they were. That just means it's because if you're married and you're both filing together, it's expected that you're roughly doubling your household income as a result. So all of these basically get doubled. This last one, the head of household filing status, is really interesting because basically you can claim head of household, and it's good to do that because look, you get the lowest tax rate, you get it at higher levels of your income. 15% stays until $50,400 instead of $37,650. So if you can claim head of household, even if you're single, that's good. In order to be head of household, you got to be paying more than half the cost of supporting a child or parent. There's other things. If you have like a boyfriend or girlfriend you're living with and they're not working and you're supporting them, you can claim head of household. But the person you're supporting has to earn very little money, like less than $5,000 a year. So ultimately, this man here is single. He's going to file as single. So the first $9,275 is taxed at 10%. Then the next $9,276 up to $37,650, that amount is taxed at 15%. And then from $37,651 up to his actual income of $43,545 is taxed at 25%. At the bottom here, it just gives you the little key for what the standard deduction is for this person and what the exemptions are. Notice head of household also gets a higher standard deduction, which is good. You want the highest deduction you can get. So if you can file as head of household, if you happen to be, unmarried, if you're living alone, maybe if you're a single parent and you have a child, and obviously you're supporting more than half of that child's costs, you should actually file as head of household. You should check the rules, and you're going to be saving money on taxes by doing that. You might think to file single because you're a single parent, but head of household is actually better. So it just depends on your status. So let's compute what the guy owes in taxes for the year. We're going to use this chart. I guess, okay, in this example, they don't really care about us computing what the guy owes in taxes. But let's do it for ourselves. Let's do it ourselves. Let's see, what's a good way to do this? Maybe like this. I'm going to blank out some of this space. We know he's going to file single, so I'm just going to erase all this. Okay, so remember his taxable income was $43,545. So here's how it's going to work. And we're allowed to use calculators. Remember, the first $9,275 of his income is taxed at 10%. So we multiply by 0.10 to get 927.50. Space this over a little bit. Now, next up, every dollar he earned between $9,276 up to $37,650 is taxed at 15%. So we don't take 15% of $37,650. We take 15% of the amount of money that's in here, which is $37,650 minus 9,276. Technically, we should be putting a 5. And we're going to be taking 15% of that. Again, you can use your calculator on this. You can literally put it into your calculator exactly as you see it here. So I'm going to do that. We do 37,650 minus 9,275. That's going to be 28,375. Multiply by, take 15% of that, multiply by 0.15. And we're going to end up with $4,256.25. Finally, we get to the man's tax bracket that he's in. That's just the highest tax rate he has to pay things at. We're going to take, hold on, let me double check something. Oh yeah, we're going to take his taxable income, 43,545, and subtract off the beginning of this, 37,651. Technically, it should be 650. And we're going to multiply that. We're going to take 25% of that. So we're going to do $43,545 minus 37,650. Multiply that by 0.25, and you're going to end up with 1473.75. Finally, the last thing we're going to do with that, all of that, we're going to add those together. That's going to be the total amount he's going to owe in taxes. 927.50 plus 4256.25 plus 1473.75. You're going to end up with $6,657.50. no tax credits were mentioned, so the man owes $6,657.50 in taxes. Of course, he also had to pay property tax and state tax, so we're not even including that. Those are separate. So, once again, this is just his taxes to the national government, the federal government. Now, that's a lot of money, 6657.5. That is a ton of money. That's not anything to sniff at. Now, if you're not careful, if you weren't saving for that, all of a sudden you owe the government almost $7,000. You're not going to have a good time with that. So here's the truth. The truth is, for most of us, those working, or I should say, especially those working in W-2 type jobs, your company is automatically going to take money out of each of your paychecks to save for income tax automatically. Because the government is not stupid. The government knows that the majority of people, if they weren't forced to save for income tax, they are not going to save for income tax. And while you may owe a lot, everybody's going to have to try to work something out to pay the government back later, and that's just going to create a huge mess. Instead, if you're working in a W-2 position, the government's going to take money out automatically. So it's pretty obvious it's so you don't get hit with a huge tax bill that you can't pay at the end of the year or at the beginning of next year. So let's say the man's company took out a total of $4,500 in what is called federal income tax withholding on the man's behalf. This is still the man's money. It's just because it's being taken out, it hasn't gone to the government yet. It has not been paid to the government or anything like that. It's basically put aside, and then later on, you can get a difference. So here's what will happen. We figured out that the man owed, well, it's gone now. Remember, the man owed, what was it, $675.50, something like that, in income tax. He's already paid out $4,500, so he really only still owes, well, we do 6,675, whatever it was that he owed. We subtract $4,500 off of that, and he's still going to owe $2,175. So he doesn't owe quite that much because his company had already been taking money out of his paycheck. So that's why whenever you work, especially if you're working a W-2 type job, you're not making all the money that your company says you're making. You're still making it, but the company's automatically taking out for income tax for you. Here's the trick. If you are a proprietor, meaning you own your own business, you sell things online, whatever you do to run your own business, you are usually going to be what's called a 1099 employee, which means you are your own employee, and you're taxed completely differently. Also, there's no company that's taking taxes out for you. So if you're not careful, you could owe the federal government a ton of money because money hasn't been taken out for you automatically. So just some good things to keep in mind. Now let's look at the income tax owed by a single woman. She has no dependents, meaning she doesn't have any kids or people that she is paying for. Her gross income deduction taxes and deductions and credits are given. We need to figure out how much she owes. So here's how it's going to work. She made $62,000 in gross income for the year. She has adjustments of $4,000, whatever those could be. Maybe that's what money she put into a tax deferred savings account. She's also going to have a tax credit of $500. Now her deductions, she's going to be able to deduct $7,500 in mortgage interest, $2,200 in property taxes. She donated $2,400 to charity and $1,500 in medical expenses. I'll bet you if we add all these up, that's going to be much higher than the standard deduction. So she's going to want to itemize her deductions because it's higher. So first and foremost, we're going to calculate her adjusted gross income. That's her gross income of 62 grand minus the $4,000 in adjustments. So her AGI, her adjusted gross income, is $58,000. After that, we're going to use this chart. She's going to file as a single female, single. She gets a standard deduction of $6,300. But like I said, she's probably going to itemize. So this probably isn't going to be something she cares about. But her exemption, she gets to take an exemption for herself of $4,050. Again, keep in mind that you don't get an exemption for yourself anymore. The standard deduction just went way the heck up to compensate for that. Of course, if you're going to itemize anyways, then that doesn't really help you anymore. So interesting to note. Now, here's the idea. She's going to get the $4,050 in exemptions. Her deductions, we add up her itemized deductions. There's a little bit of a snag here. You can only deduct any amount of medical expenses that is more than 7.5% of your adjusted gross income. So her adjusted gross income was 58 grand. We take 7.5% of that. That's $4,350. So if she had medical expenses that were more than $4,350 for the year, she would get to deduct the amount over that. So if she had $5,000 in medical expenses, she would take off, you subtract $4,350, she would get to deduct $650. However, she only had $1,500 in medical expenses, which is nowhere near that $4,350. So she does not get to deduct the medical expenses. So we add up the mortgage interest plus property taxes plus charitable contributions, which she does get to deduct, and that's $12,100. That's way more than the standard deduction of $6,300. So she's definitely going to itemize her deductions this year. So we take her adjusted gross income of $58,000. We do $4,050 in exemption plus $12,100 in deductions. She's going to get to subtract off an additional $16,150. And ultimately, her taxable income is $41,850. So now we come up here, we look at the single chart for the 41,000 whatever dollars she had in taxable income. And it looks like she's also going to fall in the same bracket as that guy from earlier. She's going to be right here. But again, not all of her income is taxed at 25%, only the amount that falls up here. A good portion of her income gets taxed at 10%, which is good. You want to be taxed at the lowest rates possible. Another portion of her income is taxed at 15%, and then only a little bit of her income is going to end up being taxed at 25%. So we come down here, so 10% of the first $92,775 is taxed. 15% of all the income between $92,776 and $37,650 is taxed. And then finally, 25% of all her income above $37,651, according to this chart. $37,650 more, up to her taxable income of $41,850. So we need to do the calculation. 10% of the 9275 plus 15% of the next bit of money, everything she made between 9275 up to 37,650 according to that chart. And then finally 25% of everything between 37,650 up to her taxable income of 41,850. So we do those step by step. We add them all up. She technically owes $6,233.75 to the federal government in income tax. But remember, she got a little $500 tax credit. You go all the way back up here. She got a tax credit of $500. Who knows what that's for? It's basically the government saying, hey, you owe us $500 less in taxes. So in reality, we take the $62,33.75 that she should be paying, we knock $500 off for the tax credit, and the amount of income tax she really owes the government is going to be $5,733.75. Now let's play pretend with that. She owes the government $5,733.75. But let's say throughout the year, the company she works for has taken out $7,500 from her paychecks for her tax, for federal income tax. So she owes the government $5,733.75, but she's actually already overpaid the government because she's already paid the government $7,500. So, in other words, she's already paid $7,500 for income tax, even though she only ended up owing $5,733.75. The reason those two values aren't the same, the reason your company doesn't take out the exact amount you need is because your company doesn't know your situation unless you tell them. Your company doesn't know that you're going to have 2 exemptions, that you're going to have these deductions for the year. You may not even know that when the year begins. So this is something that has to happen later. So she's overpaid the government. So earlier, the guy had underpaid the government, so he owed money on his taxes whenever he filed them. But here, she's overpaid. She's paid too much. So guess what? Oops. Guess what? We're going to take the $7,500 she's already paid. We're going to subtract the $5,733.75 she really owes. And that's going to be, again, we can bust out our calculators. That's going to be $1,766.25. This is going to be her refund from the government. That's why you get a tax refund, if you get a tax refund. Usually you'll get a tax refund if you're not at a super high income level. Because if you're at a super high income level, like if you're making ridiculously good money, like 500 grand a year, if you were at that income level, then you're going to be taxed at a very high rate. So your company usually has not taken out enough taxes for you. Not always, but sometimes. But whenever you're making a low income level, if you were only making $15,000, $20,000 a year, or if you're just working part-time through college, think about it. You're going to probably fall in these lower tax brackets, like the 10 or 15% tax bracket. And what that means is that your company may have been taking out too much money for the year for you. In fact, that's usually going to be what happens. So you're going to get a refund because you've already overpaid your taxes. So a lot of you, when you're younger and you're not making a ton of money, you usually will get a refund, especially because the government is especially kind of generous for when it comes to tax time for younger people and lower income earners for different reasons. There's all kinds of extra tax benefits and plans that are available to you. Again, if you get a tax credit, that's good. A tax credit is savings on your taxes, which means you'll probably get a higher refund. So just keep that in mind. You're not getting a refund because the government decides it wants to magically give you money and say, here you go, here's some money. The government is giving you back some of your money because you've already overpaid in taxes. That's what your refund is. So don't think that anyone's doing you a favor by giving you a refund. They're giving you your own money back. But it is nice in March, April, if you file your taxes then, to get a nice little check from the government. You can usually do something good with that. Okay, so we computed all this. We'll talk about this briefly, like 5 minutes, and then we'll call it a day. This will finish section 8.2. There's other types of taxes that you have to pay. We are all required to pay. Thankfully, our company, if you work for a company and you're a W-2 employee and not self-employed or anything like that, your company will automatically take these out of your paycheck for you, which is a bit annoying. But basically, there's something called Federal Insurance Contributions Act, your FICA taxes. These are used for Social Security and Medicare benefits. So Social Security, you've probably heard of it. Social Security is money that is being paid to people who are currently retired and are eligible to collect Social Security. People with health problems, eligible dependents of deceased persons, disabled citizens. Social Security is basically a safety net from the government so that these people can still receive an income even though they may not be able to work, or if they're retired, they have chosen no longer to work, or maybe they can't either. The idea is if you're working and you're paying Social Security, the longer you work and the more Social Security you pay in total, the more you will get when it's time for you to retire and collect Social Security yourself. So the way Social Security works is you're paying for Social Security now while you're working, for the people who have already retired or who collect Social Security, so that later on when you can collect, the young people and the people who are able to work then will pay for you while you're on Social Security. That's the idea behind it. It's called a defined contribution plan, as opposed to like say putting your own savings away. So Social Security is just you're paying for people who are collecting it now. It's money that's taken out of your paycheck. This is not the same as if you decide to save for retirement and you put money into retirement yourself, and whenever you retire, you're then going to have your account and you get to keep that money and use it to live on. That is an individual retirement plan, and so, or an individual retirement account. So Social Security is usually automatically taken out, and you do not have the choice to not get it and not pay for it. Medicare is also taken out of that. The way it works is your employer pays half of your FICA taxes and you pay half of your FICA taxes. So on the first $118,500 of income, you're going to have to pay 7.65% of your income of that amount in FICA taxes. That's an additional tax on top of your federal income taxes that you're paying, on top of any property taxes that you're paying, on top of any sales tax you pay that everyone has to pay. And luckily, Texas does not have state tax, state income tax. Although who knows, that could come one day. The good news is if you make over 118, it's supposed to be 118,500. If you make over 118,500, only 1.45% of the income over 118,500 is taxed. So you save a little bit on FICA if you're making a lot of money. The employer has to match. Your employer itself pays the same amount out of its own coffers, and you pay out of this. Now, the crappy thing is if you're self-employed, then you have to pay both the employee rate and the employer rate because you are both in that case. So if you're self-employed, you got to pay 15.3% of your first 118,500 in profits towards FICA taxes. So we're not really here to debate whether or not we ought to be paying these things. We're just talking about them as realities. So if you earn 150 grand a year, what are your FICA taxes? Well, 7.65% of the first 118,500 is taxed, and then at 1.5% of all income over 118,500 is also taxed. In other words, you need to take 7.65% of the first 118,500 and add on to it 1.45% of everything greater than 118,500. So we do this, we take the percents of each, we add them together. So each year you alone have to pay $9,522 out of your 150 grand in FICA taxes. Your employer also has to pay $9,522 out of its own pockets. So the government, in effect, is collecting, what is that, $19,044 in FICA taxes off of you working. So you notice when an employer hires you, when you work for a company, they're not just paying you your salary. They may also have to pay for benefits like health insurance, dental insurance, matching to your retirement account, all those wonderful things. Plus, your employer has to pay its own set of FICA taxes that it can't charge you. You pay half the FICA taxes, the employer pays the other half. So if you're making $40,000 a year, let's say, and that's your salary from your employer, well, your employer may actually have to pay $70,000 total dollars on its end to have you as an employee. So it's really easy to say that employers aren't paying enough, but in reality, they're paying a lot more behind the scenes just to have you as an employee. So that's just an interesting thing to keep in mind. Finally, we don't really have to work through this example per se. We can look at FICA taxes, your net weekly pay. But the idea is if you're a working student, you'd really like to have as much of your money as you can, because frankly, when you're young and you're working your way through school, life ain't cheap and you're usually going to be broke. I mean, the idea of being a broke college student is absolutely true, because what you're doing is instead of spending time to build your career or maybe work a full-time job that would pay you more total money, you're investing your time now and even some money to pay for college so that you can earn more in the future. And so you're sacrificing now to have more later, which is a commendable idea. But it does usually mean that while you're in college, you're broke. I was broke in college. I mean, it's just kind of like everybody knows it. You just suck it up. You pay your dues. The idea, though, is you'd like to, as you get older, you'd like to earn more money. You'd like to get a good job out of college. But then in that job or by taking other jobs, you can get promotions, you can get pay raises, and end up making a good amount of money one day, eventually. So this is just kind of one process to look at. It's kind of how life is for the college student. It's not always fun. Okay, don't go nowhere.